day. Let's go. Let's make sure we are cooking on all cylinders over here. But boy, oh boy, we got Fed meeting day. These are my favorite days. We get to play bingo. Sometimes we'll do bingo. We get to do a lot of cool things. Yeah, look, folks, we're gonna get 25. Honestly, like it would be a shock at this point to get anything other than 25. Markets, I will say though, it's a little weird. In the last like 20 minutes of trade, the bet has from yesterday gone from like 4 to like 6% chance of a 50 basis point cut. Now it's gone up to 9. So I don't know if they're like J Powell's getting some inside call options on the TLTs or something here. But it's still 91% unlikely we're going to get anything other than 25 basis point cut. But hey, one can dream, right? So anyway, let's take a look at, holy smokes, dude. I didn't realize this, that some of the real estate stocks are really blowing up. I think that's because of the stat about refinancing activity, which is really interesting because people are translating that as well to Open Door, which has, I think, the most volume right now. It is the most actively traded stock out of everything in the stock market right now. It's insane. Like, it's gonna dump, but it doesn't benefit directly off refinances. It fails off of bad systems, no matter what the market is. Now, don't get me wrong. I was bullish on Open Door from like from 60 cents to like $6. But this latest is it's the euphoric end of this one is where we sit right now on it. It's okay. So again, I'm not trying to be bearish on it. I'm just more saying, like, if you're in it, stop losses. Be careful. It's already done a 50% retrace. What's very interesting, though, a direct beneficiary of this refinancing activity is Loan Depot. Now, Loan Depot, interestingly, this morning was actually down to about 420. Oh, it went down to 404 this morning. And then this update came out about refinancing. That refinancing is up like 60% in the last 30 days or whatever it was. I saw the stat, I read it, and then I kind of blew it off. Like, I didn't write it down. I should have written it down. This happens to me sometimes. But because I'm just like always reading financial news. And anyway, so wow, look at that for Loan Depot. That's crazy. Anyway, what broadly, we'll see where we go here with markets. Markets tenuous before the Fed, totally normal. But hey, it's all going to come down to, what are we going to get? Are we going to get a hawker? Or is J Powell going to hawk to us? No, don't do that, Kevin. Is J Powell going to hawk to us? Is he going to talk to us? Or is he going to, like, stimulate us? I need a better word for that. But it's possible that, we have a Powell that did pivot at Jackson Hole. Jackson Hole, just like last year, was a Fed pivot. It was a pivot where we ended up getting Powell getting more concerned about the labor market and freaking out that things were going bad. Okay, that happened again somewhat this time here at Jackson Hole. Now the question is just, is he going to stick to that based on the latest data? Remember, the latest data is very, very interesting. We've got retail sales that are killing it. But we've got the 4-month trend of jobs at 29,000. Oh, sorry, that's the last 3-month trend of jobs. I think the 4-month trend of jobs is a little bit higher than that in the 30s, but it's very low. Now, the economist argues, well, maybe that's the new break-even rate because net migration might be 0 thanks to Trump's policies. Maybe, right? And if Powell, okay, see, now we're back at a 5% chance of 50. It's been bobbing a lot, just like it's been very, very volatile in the last, 20, 30 minutes here. Anyway, so how much is Powell actually going to care about that versus play it down with the break-even rate? So we also get the summary of economic projections this time, and this is, I think, where they're going to give us a heads up how concerned they are of the labor market. In the summary of economic projections, if you start seeing the Federal Reserve project a substantial push up in the unemployment rate, then the Fed's going to be more aggressive more frequently, right? So we'll get more of these chains of 25s, and markets are going to price that in. You've got companies, banks that are assuming the Fed's going to cut 6 times between now and March, which is basically every single meeting, 25, 25, 25, 25, 25. And so right now, I don't think there's a catalyst. I love it how I just spent 2 minutes talking about Open Door, and then somebody pops in and goes, "Hey Kevin, what are your thoughts about Open Door?" Rewind the video, would you? Just went through. You know what I will do? I'll make this promise, okay? Because just talking about it quickly on a stream or whatever is one thing, but I'm going to make you a promise. I will make an Open Door video, and I will break down what I would do if I were the CEO of Open Door. And because now they got the Shopify guy in there, and this is a tech bro. This is not a real estate guy. Okay, so I'll give you some real estate POV because that's what I do. I'm a real estate guy. I'm so excited about this cycle that we're in that, really, look, there's no matter what direction we go, rates are going down. Okay, so I wrote down Open Door video, so it'll happen. I wrote, rates are going to come down. There's no question of that. Rates will trend down either through soft landing and slower growth. We'll look and we'll go, wow, we had a boom economy in, 2021. We had a boom economy from AI in 2023 and 24. Then, we'll have a slower period. Whether it's slow enough to be a recession, hey, who knows? Doesn't really matter. What matters is that it's going to be slower and rates come down. If we go into a recession, rates come down even faster. So this is why the interest rate plays lately have been doing really well. Remember, I told you about this on the channel here. When Warren Buffett started getting into real estate stocks, that was a heads up to you. Warren Buffett bought Pool and rebalanced and increased his exposure to D.R. Horton and Lennar. That was a signal to you that Warren Buffett's going, yes, real estate, baby. To that I say yes. It makes sense. It's a pretty easy and simple play. The question is where in real estate, right? So it's really interesting. But anyway, Powell will give us that guidance somewhat in the summary of economic projections because there are 2 ways you could go with it. Either they project higher unemployment and therefore we believe they're going to go 25, 25, 25, 25, 25, or they think that their 25 that they're doing now is actually going to help the labor market. Let me put it this way. The 25 that they're doing now is not going to do jack S for the labor market. It ain't going to do anything for the labor market. So you need a series of cuts if you actually want to help the labor market. And so this is where I would make the argument that the most critical number, and I will give you my projections, okay? The most critical number, I don't care about these freaking dots. What matters here is right here, okay? You are looking at this row. These were, it's really, frankly, that row, okay? This is the row you're looking at, and then I want you all, and I have my predictions above it for what they're going to say. And then what you can also do is you can look over here to see if there's a dirty bear in there that thinks we're going to get a 5 handle, okay? Will someone go 5 handle right here? This is the information that we're going to get in 5 minutes. This is the summary of economic projections. Everybody's going to be talking about this. Nobody knows talking about the Fed better than your boy. Meet Kevin. Meet Kevin. Mr. Coupon Code. Mr. Balance Sheet.
Kevin is much more interested than most people, by the way, in the balance sheet.
Kevin's somebody would consider. Kevin is fantastic. Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Paid promotion.
That's a lot of paid promotion. But anyway, so look, in 5 minutes, we will get this. And my guess is that we're going to go 25. So, okay, we'll write this down. My guess, we get 25, we get Hunt Powell. They revise up unemployment to 4.6 for 2025 and 4.7 for 2026. And then they are literally a meme because people are going to go, oh, what's unemployment going to be? 6, 7. If they're going to be memed, that's what we're going to get, in my opinion, okay? Will somebody go 5 handle suggesting, oh, this, if we don't cut rates faster, we're going to have a 5 handle? That would be signaling. Milan, my guess is Milan will give you the worst numbers, the worst projections. That would be very, very interesting, because if he comes in with some kind of 5 handle, people are going to pay attention to it. Now, people are going to know it's Moran, so it's not going to matter, because they're just going to go, oh, well, he's a shill for the Fed, so who cares? Or sorry, he's a shill for Trump. He's on Trump's payroll, and it's true. He is a shill for Trump. And he is on Trump's payroll, basically, on the White House payroll. So, does Moran's projection really matter? No. No more than any single voting member's opinion really matters. So, of course, it's all just going to come down to the central tendency, or well, I like to use the median. I like the median number over here on the left, which is a form of middle, right? So watch that unemployment rate. That matters the most. I really think we'll see, over time, they'll talk about this being, big words you're going to get today, okay? Beta dependent, balance of risks, wait and see, 25 now, nothing else decided, right? That's my take today, okay? You get punter Powell. So this means any kind of hopes that we're going to get, there is a risk, and we talked about this in the Meet Kevin membership this morning. I'm not going to go through all of the trades that we outlined this morning for Meet Kevin members, but what we did, because we set up scenarios, like if this, then this, right? My take is, if we get some kind, I think markets, let me put it this way, I think markets are truly of the impression that Powell's going to give us some kind of longer range forecast here, and that we're going to get some kind of glorious move on the treasuries. I don't think so. I don't think we're going to get anything other than 25 and wait and see. That's what I think we get. 25 and wait and see. So we'll see. Again, the statement will be out in 90 seconds. And then after the statement is out, we will obviously cover the actual meeting, which is in about 30 minutes. And so we'll do our bingo in between that after we go through the what's it called? The release. So I'm excited about it. And we got a minute to go. So, I guess while we need something to talk about, quick little update. House Hack's kicking butt, building 12 ADUs. We've got a spec build going, really getting our new construction site going. We've got now 7 properties that we're closing here in Q3, Q4. We got multiple renovations going. At the same time, we still expect to release our beta app for our artificial intelligence that we plan to license out at the beginning of next year, which could be a revenue game changer for House Hack and a valuation game changer, obviously. We still expect to release our beta here in Q4, to be determined exactly what date, and we'll release it privately to some select course members first, then we'll go from there, some mastermind members and that. But anyway, that gives you a quick little House Hack update. And then, of course, Meet Kevin membership. If you need a coupon code, use Daddy's Back. Daddy's Back is the code. All right, ready? Here we go, boys and girls. Here we go. And it always comes through so freaking fast. I can't read it this fast. It says Federal Reserve cuts 25 basis points, additional 50 basis points by the end of the year, and another 25 in each of the next 2 years. So they're not giving us a lot of forecast, but an additional 50 by the end of the year. Dude, that's 3 cuts this year. That's more bullish. That's more bullish on rates coming down than expected. Okay. So markets were pricing in, by the end of the year, 2.2. So I gotta write that down. 2 before this changes. 2.25 is what markets were pricing in. We just got 3. That's huge. Job gains have slowed. Unemployment has edged up but remains low. New Governor Moran dissented on policy favoring 50 basis point cut. Of course, there's your Trump shill. No duh. Inflation has moved up, remains somewhat elevated. Growth has moderated over the first half. It's moved up and remains, inflation has moved up, remains somewhat elevated. Economic growth has moderated so far in the first half of the year. Fed maintains balance sheet. No changes on the balance sheet. This is not a change. This is not a surprise. We've got Fed funds at the end of 2025, 3.6 versus 3.9. 3.6 at the end of the year versus 3.9. That's an extra cut. Let's go, baby. More cuts, baby. More cuts. 3 cuts this year, dude. That's a treat. I'm actually surprised by that. That is more of a treat. Fed policymakers see 1.6% GDP growth in 2025 versus 1.4. That was, what did I put? I put 1.7, so they came in at 1.6. Fed policymakers see PCE at 3% versus 3%. That's fine. Fed policymakers see 4.5 at the end of 25. Wow, they're keeping it at 25. That's crazy to me. So this is actually staying at 4.5. And then this, they went 1.6. So I was right that they revised GDP up. But that unemployment rate, they really do not see the unemployment rate moving up. But that's so weird. I think they don't see the unemployment rate moving up because they're going to do 3 rate cuts this year. Okay, that makes sense that they're guiding for this. Now let's get the actual SEP. But this is very bullish. I mean, goodness gracious. This is great. This is absolutely fantastic. We were not expecting that. That's great. This is. It then makes you wonder, like, what do they know? You know, that's where you start scratching your head. You're like, wait, what is the Fed seeing? So let's actually get the SEP for September 2025 up here. Looking at the reaction, obviously, people are pretty excited about this, as we should be. Here's the summary of economic projections. Let's go to the dots because it's a quick, easy visual. No, there's really... Like, if I compare the dot, I don't care that much about the dots. It looks like you really, everybody moved under 3 for next. No, you got 5 under 3 for next year, 2 under 3 over here. So you definitely had a meaningful shift down. Everybody is under 4. Well, you only had 1 above 4 over here. And then you have very few above 3.5. Whereas you had more concentration above 3.5 here. Okay, September SEP, here we go. So this is where we got that revision up to 1.6. This is surprising to me that they kept that unemployment rate stable. So Fed, IMO, this is dovish. This is dovish. This is bullish. Rates down. This is bullish. QQQ 600, right? Like, this is good. Then you've got, let's see here. Unemployment rate staying at 4.5 is a very, very strong signal from the Fed. Basically, what they're telling you is, hey, guys, look, we are going to cut 3 times this year. And as a result of us giving you this extra rate cut, you better not drop the you better not screw up our unemployment rate. You see that right here? Fed funds rate, the June projection was 3.9. This is critical. That's an extra rate cut right there. So this is 3 cuts. 3 cuts, very, very bullish. Again, markets had this at 2.25. So that extra is what we're throwing in, right? So let's see here. Then you've got 25 and 25. Let's see here. You've got 25 here for next year, 25 here. Obviously, that's 5 cuts by the end of 2027. 5 cuts by end of 2027. Markets were pricing in... Oh, that'll just take me a second to see. So markets priced in end of 27 before the decision. Here it is. 5. 4, yeah. Markets priced in 5. So that aligned. That aligned with market expectations. So the big change is just that we're front loading a bit. So basically, Fed is front loading rate cuts here, hoping to keep unemployment stable. But that's a double-edged sword, right? So I look at that as a two-folded. One, it's exactly what the Fed should do, right? This is exactly what the Fed should do. However, the reason I say it's a double-edged sword is because it means the Fed is actually realizing they have to get off their ass. Otherwise, Donald Trump is going to be right and Powell's going to be too late, right? So that's a serious change here. Now, let me see if Moran sandbagged any of these numbers. So I'm assuming that the highest numbers are Moran. I actually do not see any sandbag. I am shocked. All of the Fed members are convinced that with this action, they can save the labor market. With inflation, they all basically see us at mid-twos. They're going to keep mid-twos. They're going to wash that away with flexible inflation targeting to wash away mid-twos. And no Moran sandbag other than dissent for 50, right? So whatever. That's actually more respectful than I thought he was going to be. I thought he was going to come in here and just absolutely destroy the summary of economic projections and just like tear it up, basically. He didn't do that. So this is very interesting. So I think that, I hate to say it, but that gives me a little bit more respect for Moran. Again, I hate saying that because when I listen to the guy on TV, I'm like, I don't know, man, that guy's a shill. But you know me. First of all, my goal is to be hated by everyone. That's goal number one. Goal number two is I'm gonna give you the pros and cons. I'm gonna tell you both sides, and I have to say, respect to Moran for not shitting on what's a relatively important document. He could have really screwed this up, and he did it. So he made his voice heard, mind you, with the dissent, right? Moran dissents, prefers 50, but again, this is broadly very exciting because you have now markets that in the short term need to price in this extra cutting. So look what you're getting. You're getting, oh man, this is what I said in the Alpha report this morning. Let's freaking go. I said, if we get dovish, we're going under 4, baby, on the 10-year. Let's freaking go. Oh, we're 3,997. Let's go. That's awesome. So, very, very cool. The 10-year under 4, baby. Let's go. That's awesome. That was totally an Alpha report call this morning. Along with, let's take a peek here. Oh, let's go, dude. Loan Depot's doing well. What else we got here? We've got, okay, what's going on with the Qs? Look at that Qs rocket ship, man. Let's go. This is great. So we had some real dirt there on the market for a moment because people were so nervous about Powell. Very normal. I don't love trading pre. I love getting the intel, and then I tell you right away, hey, here's my take. Is this bullish? Is it bearish? What is it? Now, be careful. We could get a dovish SEP, and we could get a hawk of a Fed. So there is a risk that Powell, he can still hawk to us, right? So let's write that down. Powell can still hawk. So let's wait and see. But Moran dissents, prefers 50. Moran does not destroy. Moran does not destroy the SEP with outlier targets on unemployment or inflation. All SEP members believe the Fed can, this is critical, folks, can sustain the unemployment rate under 4.6% through 2028. That is huge. None of them think the unemployment rate is going to skyrocket. Mind you, all it would take to change this, it wouldn't take much. One, if labor force participation normalizes, okay, and increases, right? Because we've had labor force declines recently. If labor force participation increases, unemployment rate will skyrocket to 5% rapidly, okay? Number two, if layoffs increase, unemployment rate via the beverage curve will skyrocket to 5% rapidly. Okay? Then, in that case, in either of those scenarios, every Fed member will be wrong, which means their front loading of 3 cuts in 2025 did not work or was too late. Now, keep this in mind. This is critical. Markets today, markets priced in, let's write this down. Markets priced in, what do we have? I wrote this down 1 sec.
Coupon linked below.
Markets priced in 2.5 cuts by December, and we got 3 forecast by Fed. However, markets priced in 5 cuts by end of 2027. We got 5 cuts priced by or forecast by Fed, right? So really, this is a front loading. This is a front loading to get ahead of 1 and 2 above. 1 and 2 above, these are your red flags. I'm going to put the little warning emoji here because it's really, really critical. Hit that submit button. There we go. We're going to make Fed bingo here in just a moment, but that's a critical number. So we're going to watch that. Mind you, if you don't have this yet, like if you don't have time to watch all the videos every day, not everything makes it onto here. You get so much great perspective, I believe, in the videos. But I know sometimes you all get busy and you're like, man, I just need a quick catch up with some of Kevin's data. Realize you could get it totally for free. And yes, you could change the colors. You could get it totally for free right here. This is the Meet Kevin app, and you just go to the data tab. You can also adjust your notifications like, hey, Kevin, I don't want all of your posts on like pilots or life or housing. I don't care. I just want your Fed videos. Then just change the notifications to just Fed videos. And then you could see this data in the Meet Kevin app. It's really convenient. Again, you can change the color theme if you don't like the green. I like the green, okay? Damn it. I chose the green, so I'm a little partial to it. If you go to meetkevin.com for the Meet Kevin membership, it's all green. If you go to househack.com, it's all green. I actually have to say, though, I mean, unlike this banner right here, which I threw together in like 10 seconds, so, forgive me, I know it's crappy. I have to say, I kind of like the design that we have at Meet Kevin for like the Meet Kevin membership. I like this. I think we did a good job with like the gradients and, what everything you get with the membership, lifetime access, tax deductible. I mean, all that stuff. Okay, so let's now make Fed bingo and let's see what else is going on here. We've also got, let me look at what the suits are saying. In their outlook, okay, suits are now saying, following what was observed on the labor market, it's interesting they scraped the word solid, but at the same time, the new median forecast actually represents a slightly tighter labor market. So Fed removed word solid from labor market. That's interesting. Okay, then we've got... let's see here. Okay. The skew of the dot plot remains slow. Okay, median, but the median 20 moved it all. But there are 5 members who see rates below 29.3%. That's fine. Okay. We've got 3 cuts here. That's good. And let's see what else we have. So, Fed... I'm just going through to look at Fed statement changes here. Looking again, we've got Fed reduces overnight rates to 4.25. To get to 4.6, we would need 2 cuts. I'm just fact checking myself. We need that. In order to get that, you need the 2 extra cuts, because then you would go to 3.75 to 4, and then you would go to 3.5 to 3.75, which would median out to 3.6, which is exactly what we have here, 3.6. So that's 3 cuts in 2025. Okay. Then I've got, okay, so that's that. Let me see what else the suits are saying here. The tone, oh, this is interesting. The tone overall favors growth concerns as the Fed is showing rates still, despite inflation above 2%. The lack of more dissent shows unity around the pathway to neutral. Ah, yes. That is also very interesting. I'm going to write that down. The Fed is very unified here in 3 cuts this year. Only Milan dissenting for 50 now. Again, I think more cuts now is what we need. And I'm just worried about the Fed being, well, frankly, I mean, I hate to use the word, but too late. Whoops, too many of those emojis. Okay, so let's see. Fed pressers in 14 minutes. Okay, we've got, following the language of the labor market, they scrapped the word solid. So the word solid was removed. I think this begets them seeing some underlying concern. The Fed is seeing something. So let's see here. Then I've got, in their outlook, the Fed policy slightly upgrade. I see it. So my like bear take here is this is not enough to keep unemployment stable. If the Fed thinks an extra cut or 3 cuts this year is enough to keep unemployment exactly stable at 4.5, they're probably going to prove to be too late, that's the bear take, right? And it makes sense. Bear take. Okay. So, okay, that's reasonable. Let's see what else we have here. We've got in their forecast, they upgraded their median outlook. That's fine. I've got Waller could argue. Let's see. Today's interest rate cut. Let's see. We got 3.6 for the end of the year. Okay, that's fine. Dot plot. 10-year falls under 4. Good. Modest upgrade to Fed's growth outlook next year, but they also expect inflation to be a touch higher. Let's look at that. So GDP for next year, they did bump us to 1.8, which is fine. You know, the soft, like, remember what a soft landing is, right? So this is critical. Remember what a soft landing is. A soft landing is below trend GDP growth, and 1995 yield curve gets to about 0.6 uninverted, and then normalizes back down. And it really just signals more of a signals maybe a potential post-COVID, post-AI boom slowdown, but not recession. You know, that's a soft landing. Whether we get that is entirely dependent on labor. This soft landing, let's say that, the soft landing is entirely dependent on 1 and 2 not happening. Okay, so remember, 1 and 2. These are your caution emojis here. These are critical. This is what you pay attention to. Right here, folks, 1 and 2. If labor force participation increases, and the unemployment rate will skyrocket, all the Fed members will be wrong. And if layoffs increase, all the Fed members will be wrong. That's a big deal. Okay, so now we're going to jump to making our bingo board. Again, all of this that I wrote out is already in the Meet Kevin app. So if you're on Android, go to meetkevin.com/gapp. If you're on Apple, go to meetkevin.com/app. It'll link you right to it. Leave us a 5-star review. And I honestly think it's a great app. It does what it says it's going to do. So, all right. Now, we need to make we're going to make our, bingo board. And we're going to evaluate, wow, look at that. The Q's now at negative 69 basis points. Gave up a little bit there. That's interesting. Waiting for Powie Wowie, huh? All right, let's see what happens. So we've got Tesla. Hey, Tesla, though, look at that. Look at that 414 test right to the line. This is the stuff you get in the alpha reports. All right, let's go. So, bingo board, Fed bingo, my friends. I love Fed bingo. If you want, go ahead and start giving me some bingo topics. What are we expecting Powie Wowie to say here? Obviously, I'm going to give you my take as well, because that's what I do. And I actually, we finally made a bingo board. I know some of you have seen it all in the last few times here. I just have to get it from my favorites. There it is. But I'm so grateful to have a bingo board because making it, I sucked at making the bingo board. There were so many times where it's like, oh man, Kevin, you don't count enough rows. Where's my pencil? My stupid iPad pencil though. All right, whatever. No problem. The show will go on. All right, so let's go and cook up the bingo board. All right, my friends. So first thing we're going to get is we're going to go on time. Okay, this is obvious. He's always on time. Then we're going to give ourselves, a second freebie here. We'll go purple tie, right? Purple tie, purple tie. Okay, then we're going to get balance of risks. Oops. There we go. Balance of risks. Okay, this is basically a way of saying, hey guys, I'm really nervous about the labor market. You got to pay specific attention to everything he says about that labor market. But then, of course, we're also going to get the famous one. We've heard this one from everyone.
Data dependent.
Even the Halo guy says it. Who would have thought the Halo guy would say it?
Data dependent.
All right. Then we've got, okay, so, this is where it's going to be interesting to me. I think that Powell is going to tell us about this potential normalization of the labor force participation rate. If he does, it's good because it means he's aware that it could change very, very quickly, and that would be bad for the Fed. So participation normalizing, we're going to write that down. So participation normalizing would be bad, equals bad. Okay. Not only participation normalizing equals bad, but then we're also going to have what I really should do is, let me just throw this on the computer because I think my handwriting is just going to kill everybody here. So I'll just slap this on the computer really quickly. And I think what he will say, like he won't say, oh, it's, we're worried about layoffs taking off. He's not going to say that they're worried about the labor market taking off. Instead, it's much more likely that he's just going to say something like, if layoffs were to increase, we would be prepared to move faster. So that would be an assumption there. We'll see if he ends up saying something like that. Then I think they need to come across as really believing that the labor market isn't going to roll over. They have to sell us on that idea. Sell us that you're right, that your rate cuts are actually going to be supportive of the labor market. I don't know if markets will buy it, but that's what they're going to try to do. So he's going to have to sell us that these adjustments to rates should support labor. Okay? He'll say that. I don't know that it's going to be enough. So we're going to get the word, rates are normalizing. Rates normalizing to neutral. And I think then we'll also get some talk about the not point transitory inflation, but over time transitory, right? So not point transitory inflation. Instead, it's going to be over time. So over time, back to 2%. And he won't say transitory to 2%. He'll just say we'll get back to 2% over time. That's going to be sort of his way of selling transitory. Let's see here. Then let's see here. Yeah, no, Kevin doesn't need to acknowledge, or Kevin needs to acknowledge the government layoffs are coming next month. Do you not watch the frickin' channel where we talk about this stuff every day? We know that government layoffs are coming. Come on, folks, that's already priced in. You get the labor report next month and people are like, oh my gosh, job layoffs because of those. People are just going to look at it and go, yeah, we know, but that's a one-time layoff. Like, come on, man. Like, that's already known. You get these bots sometimes in the comments that are like, oh, Kevin's purposely not talking about this. It's like, bro, wake up. It's because we're so far beyond. We're 11 miles into the marathon, and you're still, half a mile in, trying to figure out where your water bottle is. Because you're a little weenie because it's warm outside. Come on, small pee-pee.
Little pee-pee.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Kevin is much more interested than most people, by the way, in the balance sheet.
All right. Now we also need to recognize we're going to blow off. We will blow off. Powell will blow off balance sheet talk. Balance sheet talk. I think he'll have. I think he's gonna have a laptop today. I'm gonna go with laptop, and I'm gonna go with this is participation normalizing equals bad. Laptop over here. We're gonna say that would be equivalent of more rate cuts, more layoffs. Equal bad. But he's gonna say, and then there'll be more cuts. And I don't believe that he's gonna guide confidence on labor. He'll guide confidence on labor that basically, hey, what we're doing now is helping. I think he will say no recession, and the underlying is strong. I do think he's going to downplay Q3 GDP, and he'll average it to the year. Downplays Q3 GDP to average to year. Let me at least get a couple more here because we got the Fed meeting coming up. Tariffs will cause inflation. Tariffs one time over time because of how they were implemented. Implemented over time. All right. So let's get that banner out of the way. I think you all already know. Daddy's Back is the coupon for the Meet Kevin membership. Remember, you get lifetime access to that membership. So our scenarios that we come up with when events like this come out, or the fundamental analysis that we're doing on stocks, or the top 10 stocks to buy over the next 10 years. Remember, you get those, as well as the top 10 stocks not to buy. Laptop, let's go, baby! Let's go, laptop! Andy's on time!
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals, and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant.
Bearish.
In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Okay, he highlighted that extra cut because they realized those downside risks. Let's go see what the questions are now.
Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Byron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Fair, totally fair.
Oh, I'm sorry. Can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here? That tariffs
I just sent out a buy alert to the Alpha Report members, by the way, if you're in the Meet Kevin membership.
in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
So just looking at the SEP once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of...
Yields are going up because he's walking back the dovishness of 3 cuts. I'll explain that, but that's expected. He's going neutral here.
That we need to...
He doesn't want to cause persistent inflation.
Restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that
What's in 26? What do you mean he's not going neutral?
Than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television.
And remember, I did send out a buy alert to those of you in the Meet Kevin membership. Just in case you haven't seen it yet, you should have gotten an alert on the Meet Kevin app. And where else we got some?
The employment area is related to immigration, which your rate cuts wouldn't address. How do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later, and this year this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in a direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks.
I'm going to explain all of this, by the way. I know what's happening, and it will all make sense in a moment.
10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump...
Just a quick spoiler while she talks about Fed independence. What's happening is markets are nervous that the Fed is indeed going to be too late. He talks about, hey, we're going to get back to 2% inflation. He said a key phrase that turned the market. Job growth is now below break-even rate. That freaked everybody out. Why are yields going up? Because 25 was priced in for days. And he's being neutral. He's not going really dovish here. That's the problem. Neutral means rates up.
By the speeches that people give, by the decisions that we make, you'll know that
this is back on Fed independence. Mind you, and I put this on the Meet Kevin app, so you can see it in the Meet Kevin app. But mind you, I wrote this to course members. Base Powell. We don't think 25 BP move does anything to bonds. Expect flat and slightly up on yields, as I think Powell will talk up the balance of risk, data dependent, meeting by meeting. And we will slowly unprice 6 cuts by March. This is the base case 65% neutral scenario that I gave to course members this morning. And I actually wrote, my take is we're going to see yields up after Powell today because he's not bearish enough. People think he's going to be too late.
Work exactly as we always have now. And people are...
You can literally see that. That's literally in the Alpha report. And I do those every single day to give you a heads up of what to look for in the day. MeetKevin.com.
See the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
He's going to be too late, man. Stop asking about Lisa
thanks,
Cook.
Mr. Chairman. Edward Lawrence from Fox Business. So
Stupid.
We saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. And the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know.
Also
and all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
That's fair.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%. Declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in
25 doesn't
expectations.
Matter.
I mean, our market works through expectations, right? So I think our policy path really does matter, and I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minorities. Unemployment going up, you see younger people who are more vulnerable economically.
Black unemployment is a red flag leading indicator.
That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that.
Yes.
Nonetheless,
the
it's
rich are spending.
So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
It's a mistake, man.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve System and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college, and yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of, the forecasts that we see today?
Remember, we're going to break down why the market's a little red and why yields are going up. We're going to explain all of this in just a moment when we do a recap. We're almost at final questions here.
Of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Ooh. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you heard about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenges.
Market's going green right after we bought the dip. Let's go.
We're trying to accomplish. It's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there are a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you. Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
Follow up, if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in. And it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up the median for growth for this year. Actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector.
Correct.
And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage.
Yeah.
Or a lot of places in the country just don't have enough enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and that
correct.
So that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability.
We're about to do our summary here.
Moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
Not going to help.
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that.
Exactly.
But over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
Nope.
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Last question, baby. Here we go.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations, both break even in the markets and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of, running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that, we need to, continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. As I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do.
I'll get your answer, Jeffrey.
Your latter part of your question was about independence. I don't see market participants.
Close the laptop.
I don't see that that's something they're factoring in right now in terms of setting interest rates.
Goodbye.
Thanks very much.
Here we go.
Holy smokes. So the Federal Reserve today gave us one hell of a meeting. There is so much to unpack here. Let's get into it. First thing I want to talk about, the very first thing, is I want you to see the prediction that I made in writing this morning. In writing this morning, I said base case, 65% chance Powell is neutral. I said we don't think that the 25 VP move does, audio issue? What happened? Did the audio go to crap? Okay, is this better? I'll fix the audio there. Audio fine, okay, all right, the audio should be better now, there you go. Sorry, better, all right, anyway, fine, sorry. All right, we'll restart that. Okay, hold on, take another sip here now. Damn it, y'all screwed me up! It's fine, I appreciate it, actually, thank you for warning me, All right. The Federal Reserve gave us one hell of a meeting today, and there is so much to parse out of this. Are we going into a recession or not? How bad is what's actually happening? And what's Powell doing about it? Is he going to be too late? I'm going to tell you everything in this video. Spoiler alert, he's going to be too late, and it's created a little bit of a problem in markets. Let's talk about this. Quick note, I want to show you from the Alpha report this morning. Mind you, I also sent out a buy alert during the dip of the Fed meeting. Everybody who's a course member of the Meet Kevin Alpha report got an alert through our app. It's really great. But look at what we wrote this morning. This is a sneak peek into how I do my Alpha reports. So it's not like some fancy document. I'm typing it with y'all, right? But it's real. It's my opinion. And so this morning, this is exactly what we said. This is what we predicted. Powell, 65% chance he comes in at neutral. I said, we don't really think a 25 move does anything to bonds. Expect flat and slightly up on yields as Powell talks about the balance of risks, data dependent, and being meeting by meeting. Mind you, he did all of that. We will also unprice this 6 cuts by March idea, especially on the back of retail sales, Atlanta Fed GDP. And my take, we're going to see yields up after Powell today, maybe to 4.15 on the 10-year. That could hit real estate stocks a little bit and give us a bit of a dip by today. Now, something that we wrote this morning, and boy,
here's what we got from the Federal Reserve. And I'm going to give you what happened, all right? So if you want that, you just go to meetkevin.com. It's MeetKevin membership. So here's what happened. We got a 25 basis point cut. We only had one dissent. We were expecting Bowman and Waller to join in dissents. Nope. Everybody ostracized Moran, but I have to give Moran credit. He didn't go dirty on the summary of economic projections. He could have gone dirty on the summary of economic projections and really tried to sandbag the SEP, but he didn't. He didn't screw up the ranges of the SEP. He stayed broadly in line with everybody, and this Fed is unified that unemployment is going to stay in the mid-4s. Now, they gave us a forecast that we are going to get 3 rate cuts this year, with 25 basis points of cuts next year and 25 points thereafter. This means yields are going up a little bit because markets have to unprice this idea that, oh, maybe we'll get a 50 or maybe we'll get 6 cuts by March. Some banks are calling for 6 cuts by March. Crazy. But anyway, I want you to see this. We only had a 2.25%, we only had 2.25 cuts priced in. So initially, when we saw 3 cuts getting priced, bringing that rate down to 3.6 at the end of the year, that brings us down from 4, then to 3.75, then to 3.5, which is a range of 3.5 to 3.75. That's why it says 3.6. It's technically like 3.65. But anyway, that's why we initially had this, oh my gosh, this is a dovish summary of economic projections. We thought, okay, we've got a little bit of a revision up in growth. We were expecting a revision up in growth. They went to 1.6. I was thinking 1.7. I thought they would have shown more of a revision up in the unemployment rate. They don't actually think the unemployment rate's going to move up that much. The Fed is very unified here. You don't have many crazy outliers. And even though you've got Moran in here, the dots show a lot of unity with, I mean, that's probably Moran over here. But again, everybody's just going to look at him as the Trumpian shill, and it doesn't really matter. What matters more than all of this, mind you, is what Powell said. Because initially, this sounded dovish, right? We get this summary of economic projections, and markets are like, oh, this is great. We're going to get more rate cuts. But wait a minute. Then Powell gave us a dose of reality. Then Powell told us, wait, guys, we've got serious problems, and the labor market is getting worse than we thought. Now, I'm going to explain all of that. But I want you to know that his reaction to the labor market is getting worse was, but we're going to stick with 25 basis point cuts and we're just not really going to do anything about it. That does create a little bit of nervousness, but it puts you in that neutral direction. That's why I said neutral Powell, which to me is bullish for our indices, and we're probably going to get to 600 on the Qs by the end of the month. That's also one of our alpha report price targets for the end of the month. I shouldn't give away all the alpha, but that's our take. It aligns with the neutral point of view in the report that we issued this morning. Now, what we have to know are the details of what Powell gave us. This is, in my opinion, the crazy part. To understand these details, you have to know there are 2 things that you could pay attention to know if what Powell is saying about labor actually gets a lot worse. And you could get this in the Meet Kevin app, by the way, if you want it. All this is listed out in the Meet Kevin app. You could change the colors. You don't have to use this green color. But anyway, I'm going to read it off right here. So, what changes the labor market? If labor force participation normalizes, because it's been shrinking lately, it's been falling, it's been little peepee, shrinkage. Pee-pee. Nobody wants that shrinkage. If labor force participation rises again, the unemployment rate will skyrocket to 5% very rapidly, and every single member of the Federal Reserve will be wrong, and they will have to cut substantially faster, and Jerome Powell will earn his name too late. Okay? Scenario number 1, labor force participation increases. None of the Fed members are talking about it. None of them. That's a red flag. Okay? Then, if layoffs increase, this is the second, obviously the unemployment rate via the beverage curve will skyrocket to 5% and beyond very rapidly. Again, indicating that the Federal Reserve will be too late. So, we got 25. Is that enough to help the market? No. Not the stock market. Is that enough to help the jobs market? No, it's not going to make any lick of a difference to the jobs market. Now, why does that matter? It matters because of what Jerome Powell just said about the jobs market. I'm going to break that down. Now you know what the risks are. Now you know why, the yield market is moving the way it is. You also know why we bought the dip. We also know we bought the Fed dip, right? We also know why the stocks are moving up right now. But there's an underlying serious issue here, and Jerome Powell gave us multiple warnings. We're going to talk about that. I do want to quickly shout something out, and this is something that a lot of you have been asking about, and I'm so excited about this because you know how I spend like 30 grand a year to get those EPS forecasts for companies, and it's insane, like how much money this company charges. Y'all have been asking me, Kevin, is there like a consumer version of this? I've been looking for years for this, and this company came to me and they're like, Kevin, we have a product for you and we'll do a sponsorship deal with you. So this is the creme de la creme Investing Pro membership. Look at this. This is the inside of the Pro membership, okay? What's crazy about this, you could use my QR code and you get a bonus coupon code on top of their flash sale. But look at this. This is Tesla right here. Not only do you get, overviews, news, dividends, models, financials, their AI. There's so much in this. I just want to show you this one thing, okay? Look at this. Look at the EPS projections. I literally pay 30 grand a year to get EPS projections through 2029. And Investing Pro gives you all the way to 2034. This is a steal of a product. I need to cancel my $30,000 subscription and just use this. So if you go to either meetkevin.com/pro or you scan the QR code down below, you could get, not only can you take advantage of their flash sale that they have ending in 13 hours. Hey, it's not Kevin's coupon code expiring today. But when you sign up here, make sure to put in coupon code MEETKEVIN. So whatever you end up choosing, you want to sign up for or whatever, go type in coupon code MEETKEVIN. Really important you put that in. Try it. I'm blown away that I could get 9 years of EPS forecasts to do PEG ratio analysis, and I don't have to pay 30 grand. This is insane. You all have been asking for this. So again, check that paid sponsor out down below. It honestly doesn't even feel like a sponsor. I feel like I'm giving you really good value by saying we finally found it. This is great. Okay, now we need to talk about those Powell risks, okay? This is a big deal. So the Powell risks, Powell said things that I did not like at all. Okay, so here are the bad ones. First, Powell told us that the QCEW revisions, we expected that. The big 900,000 in job revisions, we expected that. That is a sign that Powell is being more neutral. His neutrality isn't good here. His neutrality, in my opinion, will end up leading him to be too late. He's not scared enough. Now, why do we think he's not scared enough? Well, we don't think he's scared enough because what he ends up saying, he says that even though right now the labor market is weakening and we're removing the word solid from the labor market is solid and we are below break even, we are only getting a 25 basis point cut. That's why bond yields are up, because we're only getting 25, which is the bond market telling you the Fed is going too slow. The bond market is screaming, Fed, you're making a mistake. That's what the bond market is telling you. I want you to understand those phrases are huge. He says, the downside risk to unemployment have risen. Disinflation continues in services, which is good on inflation. It appears we are under the break-even rate with hiring softening. Labor demand is less dynamic and softer. All bad. Tariffs are showing up, but the full effects remain to be seen, and we hope that they're going to be one-time and short-lived effects. Weird way he says that. The problem with that is he's basically telling you, hey guys, we're good on inflation. We're going to mostly have transitory inflation over time. Of course, he's not using that word, but we're going to mostly have transitory inflation over time. So he's not worried about inflation. Then he's telling you that we're under the break-even rate of employment at 29,000 jobs over the last 3 months. And then he's only giving us 25. He actually goes as far as saying that even though Moran voted for a 50 basis point cut, he says this is a risk management cut. There was not widespread support for a 50 basis point cut. Now, what's different the reason we went for 25 and why we're going for 325s this year is because last meeting, we were at 150,000 jobs per month. Now we're at 29,000 jobs per month. This suggests the labor market is, quote, really cooling, and it's time to take that into account. Damn it, Powell! If it's time to take into account that the labor market is really cooling and that we're below the break-even rate of the labor market, then wake your ass up and give us bigger cuts. This ain't enough, and you're gonna end up being too late. That's why we're seeing those bond yields tick up a bit, which was part of our neutral expectation. I expected this morning when I wrote this in the Alpha report, I told course members, I'm like, look, he's just gonna go meeting by meeting, data dependent, balance of risks. He said all three of those things. Why? Well, because why is he gonna make a big forecast now? You know, Atlanta Fed GDP is at 3.6%. You've got retail spending, which is great, although he mentioned that you gotta be careful with retail spending because it's really just the higher income consumers, right? They're the ones who keep spending. The rich get richer. Everybody else who's trying to work for a living is suffering. You got people like Elon Musk bragging about how hard he's working to earn his $1 trillion pay package. Oh, poor Elon Musk has to take a red eye at 11:30 at night from San Francisco or San Jose all the way to Austin, Texas, and it's a red eye. He makes it seem like he's sitting in a Spirit Airlines plane like this. You know, that's what he's making it seem like. I have my shorts on, so suck it. You get shorts today. This is what, guys, I had to take a red eye. I'm working so hard for my $1 trillion. Bro, he's in the back of a Gulfstream jet, sipping on champagne and in a bed. He's got a bedroom in the back of his jet, and he's trying to make you feel like he's working hard. Bro, you should be doing this if you want $1 trillion. I don't know how I got into that rant, but the point is that there is real pain in this damn economy. And Jerome Powell is telling you, yeah, shit's kind of hitting the fan, boys and girls. We're below break even. Labor is weakening. You know, it's no longer a solid labor market. And there's meaningful downside risk. These are quotes. I wrote these down as quotes. There is meaningful downside risk, which is, quote, now a reality. Yet we only get 25. Again, we expected in the Alpha report this morning that we were only going to get 25. We expected that yields were going to go up. That's fine. That was my 65% base case. I did have a neutral scenario, which I called alternate number 1, but this didn't happen. You know, right here I said very concerned, like the dovish scenario would have been, you know, we're cutting more, we're going to, you know, maybe we're even doing some QE, we want to get back to a stimulus Powell. That's what would be great for TLT. We want this Powell because it minimizes the risk of a jobs recession. We want this, but we did not get that. We also didn't expect we were going to get that, and we didn't think we were going to get a hike either. Again, 65% chance neutral, we got neutral. So you've got a Powell who's basically like, yeah, you know, we know the labor market's going to shit, but, you know, we expected that. He literally said those words. Hey, man, like these revisions, they're so large, these QCEW, yeah, you know, they were actually spot on our expectations. We expected that. I'm like, Powell, bigger cut then, damn it. Then he gets asked about black unemployment, minority unemployment, which, fact check here, black unemployment has shot up 1.5% to 7.5%. You know what Bloomberg calls that? They call that, quote unquote, that's rare outside of recessions. It is a leading indicator of a recession. This is why Powell needs to wake up. But, you know, he's like, oh, you know, but households are still in good shape. You know, we can always, basically what he's implying is, hey, like if things really hit the fan, we can always cut faster, but we don't need to do that right now. So yes, Powell is doing a really good job right now of earning his keep as being Mr. Too Late. This is not a surprise. We have the 10-year Treasury yield up modestly, 3.4 basis points to 4.06, broadly expected, okay? We have markets that are recovering, and I think we can get this slow schlager up because we don't really have negative catalysts until when? You should know this, October 1st and October 3rd. So With all that said, thank you for watching the Fed summary video. Make sure you check out our sponsor, scan that QR code, or just go to meetkevin.com/pro and use coupon code MEETKEVIN to get those EPS projections and more. Try it out. Check out the Meet Kevin membership if you want.
Coupon linked below.
If you have any questions about House Hack,
email ir@househack.com.
And that's all I got for you.
Kevin is much more interested than most people, by the way, in the balance sheet.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
Kevin, somebody would consider. Kevin is fantastic.
Welcome. Nice to have you. So you want to talk about lovemaking, right?
I love that one. I'm sorry. Sarah Eisen talking about lovemaking.